welcome to The Explainer. Today we are digging into a really popular, but man, is it a controversial income strategy, selling put options. So is this the golden ticket to financial freedom, or is it a hidden trap just waiting to spring? Let's figure it out.
Our source material doesn't just dip a toe in the water, it dives right in with this massive promise. It frames this whole strategy as one of the actual keys that unlocked early retirement and real financial independence.
And you know, it's not just talk. The creator of the source material actually shows us a smaller account, one that was used just to demonstrate this strategy. And get this, it returned an incredible 12.5% in less than 6 months.
Now here's where it gets really interesting. That 12.5% return, it absolutely demolished what the S&P 500 did in that same time frame. The market was up 2.7%. This strategy was up 12.5%. We are talking about outperforming the market by more than 4 times over.
So an outperformance like that just begs the question, right? How is that even possible? To really get to the bottom of it, we're going to stage a little debate here with 2 distinct perspectives, both pulled directly from our source. The optimist, who sees a brilliant system for wealth, and the skeptic, who sees a disaster just waiting to happen. All right, first up, let's hear the case from the optimist. This is the perspective that sees selling puts as this systematic, almost machine-like way to generate consistent, passive income month after month.
So what are we actually doing here? Well, when you sell a put option, someone pays you cash, called a premium, right up front. And in exchange for that cash, you're just agreeing to do one thing: buy 100 shares of a stock from them at a price you set today, but, and this is the key, only if that stock's price drops below your level before a certain date.
And here's that ideal scenario playing out perfectly. This is a real example from the source. A put was sold on TSM stock at a strike price of $130. The stock price stayed way above that, closing at $165. So that obligation to buy, it just vanished. It never happened. And the seller simply walked away, pocketing that $269 premium. Pure profit.
So from the optimist's point of view, this looks like a dream, right? The whole process seems simple. You've got a really high probability of winning on any given trade, and you can just rinse and repeat this thing over and over to create this steady income stream that just blows the market away.
But there's always a but, isn't there? So now let's bring in our skeptic, who looks at this exact same strategy and sees a huge, often overlooked danger kind of lurking right below the surface.
And this is the skeptic's Exhibit A. It all comes down to what's called asymmetric risk. Look at this losing trade example from the source. The absolute maximum you could ever make was capped at $335. But when the trade went south, the potential loss was over $680. You could lose more than double what you could ever hope to gain.
And look, this isn't some outside critic saying this. This is a direct quote, a stark warning from the source material itself. It openly acknowledges that one single bad trade can completely wipe out the profits from many winning ones. That's the hidden trap. And if you want to see what that looks like in the real world, nothing drives it home like the story of Bob. This guy was making a fantastic $1,500 a week selling puts. It probably felt like free money until it wasn't. He was suddenly forced to buy a ton of shares in his stock that then proceeded to just fall off a cliff, a 95% collapse, leaving him staring at a potential loss of $36,000. Just like that, months and months of profits gone.
So who's right? The optimist with the easy income or the skeptic with the catastrophic risk? Well, this is where it gets clever. The source doesn't actually pick a side. Instead, it proposes a totally refined, re-engineered strategy that's built specifically to deal with the skeptic's very valid concerns.
And it all comes down to this one crucial mental shift. You have to stop thinking of this as just a way to generate income. Instead, you start to see it as a disciplined way to buy shares in great companies you already love, but at prices you've already decided are a great deal.
Now, this isn't just a mindset. It's enforced by 3, let's call them golden rules. First, affordability. You must have the cash ready to go to buy all 100 shares. No borrowing, no margin. Second, discipline. You commit right now to never panic selling and buying the option back for a loss. You have to be willing, even happy, to get the shares. And third, and this is the most important one, quality. You only do this with fantastic companies you'd be thrilled to own for the long haul. That's how you avoid becoming another Bob.
You see what's happening here? By focusing 100% on the quality of the company you're dealing with and by having the cash to back up your play, you totally transform the risk. The so-called worst-case scenario of being forced to buy the stock, well, that's not the worst case anymore. It's actually your goal. You're essentially getting paid to wait to buy a great company at a discount.
And that really is what it all comes down to. This refined strategy, it's less about options mechanics and much more about your fundamental belief in a business. It requires the conviction to buy a company you believe in precisely at the moment when everyone else is scared and selling. So the ultimate question isn't just about the strategy, it's about you. Are you a disciplined investor, or are you just catching a falling knife?